Prepaid expenses tell the story of timing, judgment, and control, and it's the responsibility of accountants to ensure that the story is clear, accurate, and supportable. In this video, I'll walk you through how prepaid expenses move through a company's accounting records from the moment the invoice arrives or cash is paid, to the monthly adjusting entries, and finally to the balance sheet reconciliation every accountant must know how to prepare. This topic is quite important whether you work in corporate accounting, auditing, FP&A, or even a startup where you're the one-person accounting team. Nearly every company has prepaid expenses, and handling them correctly prevents misstated expenses, misstated cash flow, and audit issues. And by the end of this lesson, you should understand why the adjustments are needed, how to calculate them, and how to prove that the account is correct through a proper balance sheet reconciliation. Adjusting journal entries fall into two broad categories: deferrals and accruals. Prepaid expenses are a classic example of a deferral because cash is paid before the expense is actually incurred. And you'll see this constantly in your career. Software subscriptions, insurance, rent, service contracts, support agreements, marketing, and more. These are examples of where you'll encounter prepaid expenses. Accruals are the opposite. Expenses happen first and cash happens later. But today we're focusing only on deferrals and specifically prepaid expenses. Understanding this distinction helps you quickly diagnose whether an account is missing an adjusting entry during the month-end close process. A prepaid expense is an asset because the company has paid but not yet received the full benefit. That is why the amount is recorded as an asset initially. Accountants often call that capitalizing an invoice. And then over time, as the benefit gets used up, we gradually move amounts from the balance sheet to the income statement. This is a perfect example of the accounting principle of matching, recognizing the expense in the period that receives the benefit. In your future job, you'll often be the one explaining to a manager or auditor why something is capitalized as a prepaid rather than expensed immediately. This is the three-step prepaid expense framework, and it applies to every prepaid expense you'll ever see. In step 1, when the cash is paid, we review the invoice and contract and record a prepaid asset. One important real-world note, though, companies often set a materiality threshold. If a prepaid amount is, say, below $1,000 or $2,500, depending on what the company defines as their materiality threshold, accounts often expense it immediately because it's not worth the administrative work. In step 2, we record an adjusting entry to recognize a portion of the expense according to how much the company has used up in terms of the associated benefit. And then finally, in step 3, we reconcile the prepaid account to confirm the remaining balance represents the unused portion of the prepaid expenses. This process, scheduling, recording adjustments, reconciling, is an important part of month-end close, and nearly every entry-level accounting job includes this responsibility. Here's the example we're going to work with. ABC Company pays $237,400 for a 12 months radio advertising contract. And the invoice tells you the amount and timing, but the contract gives important details. What exactly is being purchased, how many commercials, frequency of service, and sometimes even which month contain more value. This contract review step is a major part of how audit and internal controls work, and it matters because the expense pattern must follow the delivery of service. Most companies enter the invoice into the accounts payable module of the company's accounting system. This debits the prepaid asset and credits the accounts payable account. Really the same as the manual journal entry you see here, with a debit to prepaid advertising and a credit to cash for $237,400. And after AP processes the payment, cash decreases, but the expense still has not been recognized because it is still in the prepaid asset account. This is exactly why auditors always check prepaid accounts. It's easy for companies to have large balances here that are never expensed. Here's a simple amortization schedule which shows the description of the radio advertising and the amount of $237,400, as well as the expected expense of $19,783 per month, which is calculated by dividing $237,400 by 12 months. However, if the contract specifies uneven delivery, for example, more commercials during certain months, you must expense based on that usage pattern. The adjusting entry reduces the prepaid asset and increases the expense. And after the first month, the balance becomes $217,617 in this account. Now, in real accounting systems, this schedule is often automated, but accounts are still responsible for verifying accuracy. And a common issue with automated entries is that small variances remain at the end of the amortization time period due to rounding. A key takeaway is that the remaining balance on the balance sheet should always represent the portion of the contract that has not yet been used. That brings us to the third step, tying out the support schedule to the general ledger account report and preparing the balance sheet reconciliation. A proper reconciliation ties the general ledger to the support schedule. And if the numbers don't match, something is wrong. Either an incorrect entry was posted or the schedule wasn't updated. We first generate the general ledger detail report for the prepaid advertising account and see that it has a balance of $217,617. Then we match that balance to the amortization schedule, which agrees in this case. Now, if it doesn't agree, review the general ledger detail to see if there's another invoice or journal entry that posted to this account, and if it requires you to update the support schedule or enter a correcting journal entry. In audits, prepaid accounts are commonly selected because the math is simple, the documentation is clear, and errors are easy to detect. Being able to prepare a clean reconciliation will make you stand out in early career roles. The reconciliation always includes the general ledger balance, the supporting calculation, and sign-offs. Larger companies use tools like Blackline or Flowcast to manage this process. For this reconciliation, we prepare the cover page. For the account reconciliation that shows the general ledger balance, as well as the subledger balance from the support schedule, and that both of them match at $217,617. The preparer signs off on the reconciliation, and the reviewer reviews and approves the reconciliation, and the task is checked off on the reconciliation and month close tracker. Auditors will often ask for the invoice, the contract, and your schedule so they can reperform the math. Good documentation makes the audit easy, and poor documentation creates hours or sometimes days of unnecessary back and forth. New accountants can learn a lot about the business by reviewing balance sheet reconciliations, and as a new accountant, reviewing balance sheet reconciliations like this one is one of the best ways to truly understand how the business operates and how transactions flow through the financial statements. Every prepaid expense tells a story, and your job as an accountant is to make that story clear, accurate, and supportable. Once you master this process, you'll be able to handle many other adjusting entries and reconciliations with more confidence. And if you continue into roles in audit, FP&A, or corporate accounting, you'll see prepaid expense schedules every single month end close.